Hey guys, what's up? I'm Erin and welcome back to the channel. So here's the scenario. Your spouse passes away and you inherit their traditional 401k or their traditional IRA. You're in the middle of grieving, but the problem is this is also one of the most complex areas of inheritance rules in the tax code. If you get it wrong, the IRS can penalize you, saddle you with higher taxes, or force withdrawals sooner than necessary. The good news is surviving spouses have the most flexibility of any beneficiary. The bad news is, with so many choices, it might be easy to choose the wrong one. So in this video, I'm breaking down every option for surviving spouses inheriting a traditional IRA, 401k, 403b, or 457b in 2025. You'll see how the rules change based on account type, whether your spouse had started RMDs, and whether you're the sole beneficiary. So stick with me because smart planning can save you thousands. Before you make a single move, there are 3 critical questions you need to answer. Number 1, what type of account is it? If it's an IRA, the IRS rules apply directly. If it's an employer plan like a 401k, 403b, or 457b, the plan's own document controls. Some plans don't allow all the options that the tax code permits. For instance, some 401ks might require a lump sum withdrawal unless you roll it over to an IRA. So before you do anything, make sure you check the plan documents. Number 2, when did your spouse die relative to their required beginning date? RBD. The RBD is the date by which someone must start their first required minimum distribution, or RMD. For traditional accounts, right now that's April 1st of the year after turning 73, and that age will increase to 75 in 2033. For employer plans specifically, there is often a still working exception, so if your spouse was still employed and didn't own 5% or more of the company, they may not have hit their RBD, their required beginning date yet. Here's the nuance. If you treat this account as your own, the required beginning date for RMDs will be based on your age. But if you remain the beneficiary on the account, the required beginning date, so the start of RMDs, will be dictated by your deceased spouse's age. And number 3, are you the sole beneficiary spouse? If you are, you get to lock in special treatment, like using the uniform lifetime table for smaller RMDs or delaying required distributions until the year your spouse would have turned 73. But if there are multiple beneficiaries and you don't split this account by the deadline, you may lose access to those more favorable rules. And one last filter to keep in mind, your age matters too. If you're under 59 and a half and you roll the account into your own IRA, withdrawals are subject to a 10% early withdrawal penalty. So in this case, keeping it as an inherited IRA would give you access to this money completely penalty-free if you're under the age of 59 and a half. If you're over 59 and a half, rolling it into your own IRA can make a lot more sense when it comes to long-term planning. So once you answer these 3 questions, account type, required beginning date, and whether or not you're a sole beneficiary, you'll know what path to take. Step 2, these are the core options for spouses for IRAs. Option A, treat the IRA as your own. This is a spousal rollover. One of the most common choices a surviving spouse has is to simply make this IRA their own. They can do a rollover to their own IRA, or they simply can retitle it into their name. From that point forward, it's looked at as their own account, and RMDs would be based on their own age. And this is an important detail. If you become the owner in the same year your spouse passed away, you are also responsible for making sure any year of death RMD your spouse still owed gets taken. And remember that big caution. If you're under the age of 59 and a half and you roll this IRA over to your own IRA, you lose penalty-free access to this money. If you make a withdrawal after doing that, you would be subject to a 10% early withdrawal penalty. So for younger spouses, it often makes more sense to leave it as an inherited IRA because that way you can make withdrawals from this account at any amount, any time, without facing any penalties, no matter what your age, no matter what the age of your spouse who passed away was. And here's the good news. There are no hard deadlines. You can simply leave this as an inherited IRA for as long as you wish. And then maybe once you turn 59 and a half, for simplicity's sake of your own estate, maybe you decide to roll it over into your own IRA. You have that option, but waiting until 59 and a half would give you access to this money should you need it. So the strategy is flexible. If you're younger and you need access to this money, maybe you leave it as an inherited IRA. If you're older and you wouldn't face these penalties anyway, and you just want a more simple management of your money, maybe you roll it over into your own IRA. Let's say you're 50 years old when you inherit your spouse's IRA. If you roll it into your own name right away, any withdrawals you take before the age of 59 and a half would face a 10% early withdrawal penalty because you're under that magic age. But here's the key point a lot of people miss. If you keep that account as an inherited IRA, you can access this money penalty-free at any age. It doesn't matter if you're 50, if you're 45, or even younger. It doesn't matter how old your spouse was when they passed. Withdrawals from inherited IRAs are never subject to the 10% early penalty, no matter what. Of course, you still owe ordinary income tax on the traditional IRA withdrawals. There's just no penalty layer on top. Then, once you hit 59 and a half or 60, you can roll that account into your own IRA to simplify management and take advantage of the more favorable RMD rules. Option B is to remain a beneficiary, have an inherited IRA in your name. In this second option, you keep this as an inherited IRA. In this setup, your deceased spouse would stay as the account owner for tax purposes, and you're treated as the beneficiary. Now, here's how the rules break down. If your spouse died before their required beginning date and you're the sole beneficiary, you can actually delay RMDs until the year they would have turned 73. After that, you can begin taking withdrawals based on your own life expectancy, or if it's better for you, treat this account as your own. This is one of those unique flexibilities that's offered to surviving spouses. The thing to keep in mind here is that the RMD is tied to your spouse's age, but the withdrawals are based on your age. Alternatively, if your spouse died on or after their required beginning date, you do have to keep taking RMDs every year. But here's the good news. The IRS allows you to take the longer of two factors, your life expectancy or what your spouse's would have otherwise been. This would allow you to stretch your distributions more over time. And there is an additional special perk for sole spouse beneficiaries. In some cases, you can use the uniform life table instead of the single life table. That means smaller required withdrawals every single year, which can leave more of this money growing tax deferred. Let's say your husband passes away in 2025 at the age of 70 before he had to start taking RMDs. You're 65 and the sole beneficiary. Because he died before his required beginning date, you don't have to take anything out right away. In fact, you can delay RMDs until the year he would have turned 73. At that point, you begin taking annual distributions based on your own life expectancy, giving you a few extra years of tax deferral. Now let's flip it. Suppose your wife passes away in 2025 at the age of 80, so she was already taking RMDs. You're 70. Because she died after her required beginning date, you do have to keep taking distributions every year. But here's the advantage. The IRS lets you use the longer of her remaining life expectancy or your own. In this case, your life expectancy is longer, so your RMDs will be smaller than hers would have been, because you will base it off your age, which keeps more money in the account growing tax deferred. Option C is to elect the 10-year rule or the 5-year rule in rare cases. As a spouse, you're usually eligible for life expectancy payouts because you're considered an eligible designated beneficiary. But here's the thing. In rare cases, you might actually choose the 10-year rule instead. This rule works the same way as it does for most non-spouse heirs. No required annual distributions in years 1 through 9, but the account has to be completely emptied by the end of year 10. This does assume that the account owner died before RMDs kicked in. So why would a spouse ever go this route if life expectancy payouts are available? Well, the answer is flexibility and control in rare circumstances. With life expectancy RMDs, you are forced to make a withdrawal every single year, whether you want to or not. But with the 10-year rule, you have the option to take out nothing in years 1 through 9, but the full account must be depleted by the end of that 10-year period. So if you have some high income years early on, you could take out nothing during that period and then start taking withdrawals later on. one. That flexibility can be powerful in certain situations. For example, maybe you're still working and you're in your peak earning years but plan to retire soon. Instead of stacking withdrawals on top of your current wages, you could wait and take larger distributions once your income drops. It could also work if you're expecting a major deduction, like you have a major medical expense coming up or you're moving to a low tax state. In other words, the 10-year rule lets you time the income strategically. And this could, in certain situations, lower your lifetime tax bill while it does force the entire account to be emptied within those 10 years. Here's the reality though. For most surviving spouses, the 10-year rule is not the most tax efficient choice. Instead, rolling it over to your own IRA or sticking with life expectancy tables preserves more of the long-term tax deferral. Think of the 10-year strategy as really a niche option, not the default option for surviving spouses. And finally, there's also the 5-year rule, but that's rare. It only applies if there's no designated beneficiary at all and your spouse died before their required beginning date. In that case, the account must fully be drained within 5 years and there are no RMDs during that time. Here's where things get really interesting. As of 2024, Secure 2.0 added a new option for spouses who inherit a defined contribution plan, like a 401k or a 403b. It's called the spousal election, and it allows you, as the surviving spouse, to be treated as if you were the employee all along. Here's why that matters. If your spouse died before their required beginning date, you can delay RMDs until the year your spouse would have turned 73. That can buy you a few extra years of deferral. And once you start taking withdrawals, you can use the uniform life table instead of the single life table. That's important because it usually results in smaller withdrawals, which is a lesser tax bill to you and allows more money to stay in this account, growing tax deferred. Now, some plans even allow for this if the employee died after their required beginning date. But, and this is a big but, the employer plan always dictates, and not all employer plans allow for this. So before you make any moves, before you make any decisions, make sure you read the plan guidelines because they will control. This is one of the most common spots where people get tripped up. If your spouse has already taken RMDs, but hasn't yet taken the RMD in the year they pass away, you as the beneficiary are responsible for making sure that RMD gets taken. The IRS gives you until the later of 2 dates, your tax filing deadline for that year, or December 31st of the year after death. And as long as you handle it by the appropriate deadline, you avoid any penalties. And the penalties are pretty steep, so it's something to be aware of. As of 2025, the penalty is 25% of the missed RMD, but that does drop to 10% if you correct it quickly. This is really the cleanest path to making sure that RMD gets taken completely penalty-free for the year of death. Now let's talk employer plans. As a surviving spouse, you generally have the right to roll over employer plan assets like a 401k or a 403b into an IRA. Once that money is in an IRA, you kind of hit a fork in the road. You can treat it as your own IRA, which means future RMDs are based on your age and you treat this account as if you've always owned it. Or you can keep it as an inherited IRA, which may give you more flexibility in the short term, especially if you need immediate access to this money. The key thing to focus on here is age, that magical age of 59 and a half. If you roll that money into your own IRA and you're under the age of 59 and a half, well, all of a sudden you lose access to this money, at least on a penalty-free basis. If you do make a withdrawal from this account and you're under the age of 59 and a half, you will face a 10% early withdrawal penalty. However, if you leave it as an inherited IRA, there is no early withdrawal penalty regardless of age. So the decision really comes down to your age, your income needs, and your long-term tax strategy. A younger spouse who may want to access this money may decide to leave it as an inherited IRA. An older spouse, someone older than the age of 59 and a half, may choose to simply roll it over into their own IRA. So perhaps this brings up the question, if you inherit a 401k from your spouse, should you keep it in the employer plan or roll it into an IRA? Most of the time, it makes the most sense to roll it over to your own IRA or have it as an inherited IRA, but there are some situations in which it can make sense to keep it with the employer's plan for a while. For example, if you're younger than 59 and a half and you need access to the money, employers employer plans often have special rules. If your spouse left their job at 55 or later, you can generally access the funds in a 401k early without any penalty. This is known as the rule of 55. However, if you take those funds and roll them over to an IRA, you generally lose early access. So it might make sense to leave those funds where they are. Otherwise, if you roll it over to an IRA, you would then face a 10% penalty on the exact same withdrawal. Also, some employer plans offer very low institutional investments or even better creditor protections than an IRA. And if this is important to you, well then it might just be worth keeping that account exactly where it is. And under the new Secure 2.0 rules, some plans automatically allow the spousal election, which can mean smaller RMDs by letting you use the uniform lifetime table. But that's not always available in all setups. Now on the flip side, here's when a rollover can make more sense. If you're over 59 and a half and don't need the early access provision anymore, if you want broader investment options than what the 401k menu gives you, if you want to simplify and consolidate your accounts so you're not juggling multiple statements, or if you want to keep the door open for a Roth conversion, which is often much easier to do from an IRA than it is from an employer plan. So perhaps here's a general rule of thumb. If you're under 59 and a half and leaving it with the employer-sponsored plan would give you immediate access to these funds and you need that access, maybe it's best to leave it where it is. If you're over 59 and a half and you just want to simplify and streamline your financial plans, you want to consolidate, go ahead and roll it over to your own IRA or keep it as an inherited IRA, whichever choice you deem is best for you. But before you do anything, make sure you read about the employer's plan because not all employer plans operate the same way. Here's the unglamorous truth that's easy to forget. Every dollar that comes out of a traditional IRA or traditional 401k is taxed as ordinary income. That means those withdrawals don't live in a vacuum. They stack on top of everything else, your wages, any business income, a pension, and they can push you into higher tax brackets. That can affect how much of your Social Security becomes taxable. It can make you be impacted by Medicare surcharges, those IRMA surcharges. It really does impact your taxes. And if you receive this inheritance in your peak earning years, this can be a very large tax burden. That's why the choice between a spousal rollover and an inherited IRA isn't just a paperwork decision, it's a tax planning decision. The right path has to fit within your overall income picture, and that's going to depend on your age, your income, your tax bracket, and your overall retirement strategy. So in short, don't just ask, what can I do? Ask, when and how does this fit into my broader tax strategy? If you're inheriting as a spouse, here's a simplified checklist. 1. Identify your options early. Remember, employer-sponsored plans can be much more strict than IRAs, so read the plan documents. Decide whether to treat it as your own IRA or keep it as an inherited IRA. The right choice depends on your age, your tax bracket, and your income needs. Don't overlook the year of death RMD. If your spouse hadn't yet taken their RMD in the year they passed away, make sure that gets done. If it's an employer plan, see if the new Secure 2.0 spousal election applies. This option can give you extra deferrals or smaller RMDs in the right circumstances. The bottom line, spouses have more flexibility than any other group of beneficiaries. But with that flexibility comes complexity. Get it wrong and you can trigger unnecessary taxes and penalties. Get it right, you can maximize your deferral and lower your lifetime taxes and really maximize the inheritance your spouse left to you. So what are your thoughts? Leave them in a comment down below. I post new videos every single week. If you got anything at all out of this one, please give it a like. If you're new here, please consider subscribing, or if you know of someone who might get something out of this type of content, please consider sharing. I'll see you soon. Bye. But there are maybe. Jeez, oh Pete. Send them on over. Listen, I solely use talk to text, so if you ever get a text from me, it's probably got a lot of random words and typos. Same thing for YouTube comments, but life is so much quicker and easier if you do talk to text, so I am not going to do anything different. I might have to take a lunch break here. Been filming for 2 hours. I got some long stuff today. Let me give you an example. No, my battery just died and my camera is breaking and I can't let it run out because it'll be bad.